Now that we're at the next stage of the property cycle, should you change your investment strategy? And what type of property is going to outperform over the next couple of years? That's exactly what I'm going to discuss on this week's show, as well as sharing with you one of the big differences between winners and losers.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
When it comes to property investing, you'll often hear two conflicting philosophies. Some say you should invest for capital growth, and others say you should invest for positive cash flow. Now that we're at the next stage of the property cycle, where capital growth is going to be lower for a number of years, I know more investors are asking maybe they should change their investment strategy. Maybe they should look for cash flow positive properties. Well, that's what we're going to be discussing in today's episode of the Michael Yardney podcast. For the first half, I'm going to explain to you a bit about the right strategy for this stage of the property cycle. And in the second half, I'm going to explain to you my thoughts on the right property for this stage of the property cycle. So welcome to this week's show. In particular, welcome to all the new listeners, and thanks for the rest of you who are coming back and having me in your ears once more. I'm having a lot of fun putting these podcasts together, and thanks for all the great feedback. So as a special bonus for my podcast listeners, I'm inviting you as a guest to my annual property market and economic updates I'm conducting in 4 states around Australia. You can come for free by putting in the coupon code podcast. So go to propertymarketupdate.com.au, get all the details, put in the coupon code podcast, and you can come along as my guest. I'd love to catch up with you personally. Okay, so back to today's show. What's the right strategy for this stage of the property cycle? So as I said, some people are wondering, well, maybe if there isn't as much capital growth, I should be looking for positive cash flow properties. You know, properties where the rental income covers all the property's expenses, including interest, and maybe even leaving a bit of money in your pocket each month. Now, since there are two strategies, which is better? Now, I know some people would say there's no clear answer. Clearly, if they say if both properties exist, there's a place for both. And there is. But if you want to be successful, no, there isn't. Let me explain. I see more beginning investors invest in cash flow positive properties. On the other hand, I tend to see more successful investors, those who've built a substantial asset base, grow their portfolio through leveraging off the capital growth of their investments. Now, of course, I can understand why beginning investors are keen to buy property with positive cash flow. They tend to be cheaper, so it's easier to purchase and it's easier to support that type of property. And while these properties may have some short-term income, the problem is they'll never allow you to accumulate enough equity, enough assets to become truly wealthy. And while the rent may seem high initially, it's the ongoing capital growth of your property that's going to underpin its long-term rental returns, which means that if you buy in a low capital growth area, your rents won't increase anywhere near as much as properties that have been bought in a high capital growth area. Now, sure, cash flow is important, but if you think about it, that few dollars extra a week cash flow you might receive is not really going to make that much difference to your lifestyle, but the lack of capital growth that you're going to have is going to hamper your ability to get the deposit for your next property, and the lack of rental growth is going to hamper your ability to service more debts. And when interest rates rise, and they eventually will, a property that's cash flow positive today may well be cash flow negative tomorrow. So you won't have the cash flow and you won't have the capital growth. In my mind, an investor's focus should be on building their asset base so they can eventually develop the passive income. It's got to be the right way round. Asset growth first, then cash flow. Now, since properties with higher capital growth have got lower rental returns, you won't find cash flow positive properties in the high growth, better locations of our capital cities. I guess that means you're going to have to look to regional areas or secondary areas where buyers require a higher yield and more cash flow to make up for the lack of capital growth. However, one of the main reasons properties increase in value is because of their scarcity. because of the land they sit on, meaning you should only buy properties with what I call a high land to asset ratio. The land component makes up a substantial portion of the value of your property. Now, if you think about it, when you buy cash flow type property in the regional areas or the outer areas where prices are lower, the land value per square metre tends to be lower because there's plenty of available land. This means that the dwelling, accounts for much of the asset's value, and in these locations, the dwellings tend to lose their value faster than the land gains value. Thus, it hampers your long-term capital growth. On the other hand, when you buy a high-growth property, it's like you've purchased a property in an area with limited supply of land, well, at least relative to buyer demand, and that means your land to asset ratio is likely to be higher, meaning the land component makes up a higher proportion of your property's overall value, giving your assets strong capital growth potential. Now, don't misunderstand me. The ultimate aim of property investments is to get cash flow. Of course it is. Cash flow that's going to give you the financial freedom that you want. But you've got to get things in the right sequence. Your investment journey is likely to compromise, 20 to 30 years. So you've got to go through the following phases. Number one, the accumulation phase. This is where you build your asset base, your net worth, through capital growth of well-located properties. Now, you can speed this up by manufacturing some capital growth during renovations or development. The next phase is the transition phase. Once you've got a sufficiently large asset base, you slightly lower your loan-to-value ratio so you can eventually move onto the cash flow stage. That's when you can live off your cash machine of your properties. So get it in the right order. And if you think about it, when you retire, the majority of your assets isn't going to be money that you've saved. It's not going to be rent that you've earned. It's going to be the capital growth of your properties. But the question some people ask me is, well, that's okay, Michael, but how do I cope with the negative cash flow in the meantime? Of course, I understand why they're saying that, because investing in negatively geared high-growth properties means you're going to have to cover that cash flow each month as money flows out of your pockets. Now, one way of doing that is to set up the correct loan structures up front before you buy. For example, you might use a line of credit to supplement the rental payment to pay off the interest each month. Now, what I'm suggesting is you wouldn't just count on your personal cash flow. Now, you may have it, but setting up the right loan structures to cover the shortfall for 2 or 3 years until the property's value grows sufficiently that you can refinance it again, or till the rent goes up, that's a common business strategy. Now, people say, yeah, I'm actually borrowing money to pay the interest. I don't like that concept. Well, let me make it clear. It's a very common business concept. If I was going to buy the coffee shop downstairs, I'd go to the bank and I'd say, look, Mr. Bank Manager, I need some money for goodwill and I need some money for the stock and the equipment. And I know my business isn't going to make much cash flow in the first couple of years. So could you please lend me some money I want to have something set aside for working capital for the next couple of years. And that's exactly what you're doing as a property investor, to give you the working capital for a couple of years as your property investments grow. Of course, to use this strategy, correct asset selection is critical, because to make it worthwhile, you need your property's value to increase faster, more significantly than the outstanding loan balance that you're using to pay for the interest. This means you're going to be needing to invest in high-quality assets, investment-grade assets, so you can maximise the chances of enjoying strong capital growth. Now, I also want to put a disclaimer here. This strategy isn't without risk. The 4 major risks I can see are, number 1, poor capital growth. Again, that's why correct asset selection is so important. Number 2, interest rates may rise. Now, of course, you can protect yourself by fixing interest rates, some of it or all of it. Poor rental growth is another risk, which highlights again the importance of owning the sort of properties that are going to be in continuous strong demand by a wide demographic of tenants. Lack of financial discipline is another risk. You should never set up these financial buffers and then use them for other things other than property-related expenses. I see people setting them up and then frivolously using the money for other things. So the bottom line for the first half of today's show is that I can understand why property investors would be keen to buy a property with positive cash flow. But let me again remind you that while they may give you short-term income, these properties will never allow you to accumulate the equity necessary to become truly wealthy. Remember, as a property investor, your focus should be on safely building assets, building your asset base over time so you can eventually develop the passive income that's going to allow you to enjoy the financial freedom that you want. Now that you understand why I don't think you should deviate from a proven strategy, one that's known and has worked over multiple cycles, after the break we're going to have a bit of a chat about what the right sort of property is going to be in this different property market climate.
Are you wondering who you can turn to for independent and unbiased advice? Metropole has helped beginning investors buy their first property, experienced investors add to their portfolio, and sophisticated investors manufacture capital growth by becoming property developers. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. It's a great feeling having the independent team at Metropole helping you formulate and implement your wealth-building property investment strategy. Arrange a time for an obligation-free chat at metropole.com.au. Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Would you like to know the big difference between winners and losers, between successful people and the average person? That's what I want to discuss with you in my mindset moment today. And thanks for the great feedback I'm getting on these mindset sessions also. I know a lot of beginning investors think, what's all this metaphysical baloney stuff? I just want to know all the real estate stuff. While most successful investors, entrepreneurs, business people recognize that success is a mindset. Those who've grown successful property portfolios or businesses have had to grow their mindset to be able to maintain their wealth. So today I want to discuss one of the big differences I've seen amongst the winners and the losers. Because over the years, I've had the privilege of working with some very, very successful property investors, business people and entrepreneurs. I've done so in my mentorship program where over the last decade I've mentored over 2,000 people, but I've also met some not so successful investors. And I found that in general, people fall into two groups. Those who make excuses and those who don't. The ones who make excuses, they don't start that way. No one's born talented at making excuses. But over the years, they learn to get out of things. They learn how to blame the economy, their parents, their teachers, the system, pretty much anything they can deflect the blame on. These give them the excuses that they need. And then there are the people who don't make excuses, or rather won't. Look, we've all got our difficulties, and some days we feel like making excuses. But winners stop themselves. They don't make excuses. They get the job done. Now, interesting, we all have similar capabilities. Yes, we've got similar capabilities to get things done, or not. Or to make excuses about it, or not. So when you wake up in the morning, you get to choose which route you take. Now, I recently read an insightful quote. It said that the difference between successful people and unsuccessful people is that smart people hate doing the same things that unsuccessful people hate doing. But successful people do them anyway. That's the big difference. So the difference between successful and unsuccessful people is that these successful people hate doing the same things unsuccessful people do. But they do them anyway. So as you go into this journey we call life, you're going to get a chance to back out and make excuses or not. You've got the choice. You decide.
If you're enjoying our show, please subscribe on iTunes. You'll find us there as Michael Yardney Podcast, and we'd really appreciate it if you would leave us a review. When you do, we'll read it out on the show. By the way, Michael creates a lot of content he only sends out by email, which you can have with no obligation. So also visit michaelyardneypodcast.com and subscribe to his commentary there.
Well, a moment ago we spoke about what's the right strategy at this stage of the property cycle. So now I'd like to turn my attention to what's the right property for this stage of the property cycle, because clearly we've moved to a stage where there's not going to be as much capital growth. We've had a couple of years of exceptional capital growth, particularly in our two big capital cities, and we're now in for a period of lower growth. So back to the original question. What's the best investment in these years ahead? Look, one thing's certain. There's no such thing as a perfect investment. If somebody tells you they've got the perfect investment for you, be very skeptical, or at least ask lots of questions, but I'd probably run away because chances are they're trying to sell you something you shouldn't buy. So what do I look for in an investment? I look for the following. I look firstly for something that's strong with stable rates of capital appreciation. I look for property that's going to give me steady cash flow. I look for liquidity. That's the ability to take out my money either by selling or borrowing against my investments. I look for an investment that's easy management. I look for a hedge against inflation. Now, I'm explaining about investments in general, not just property. I also look for something with good tax benefits. Now, when you look at the various categories of investments, you'll recognise that not many fill the bill when it comes to all of these criteria. So to grow your wealth in this current stage of the property cycle, you're going to have to invest in assets that are both powerful and stable. Now, by powerful, I mean that they have to have the ability to appreciate in value at what I call wealth-producing rates of growth. Now, this usually comes with the ability to borrow against them and leverage against them, or the ability to add value to them. By stability, though, I mean investments that should grow steadily in value and surely without major fluctuations in value. Many investments are powerful and many are stable, but few are both. Now, prime residential real estate is one of the investment vehicles that's got both power and stability in spades. Now, that doesn't mean it's perfect because property is not as liquid as many other investment classes. It can take months to get cash out of your portfolio if you have to sell a property, and sure, you may be able to do it a bit quicker by refinancing, but even this takes time. So while some people would say the lack of liquidity of property is an issue, I'd argue it's actually one of the virtues of property as an investment vehicle. You see, the only way an investment can achieve liquidity is to relinquish some of its stability. If it's liquid, easily sold, like shares, it's more likely to have more volatile fluctuations in value. Now, let's examine this concept just a little bit further by looking at the stock market. The stock market's another potentially powerful investment vehicle because you can borrow against the shares you own. But in order to achieve the liquidity the stock market provides, it has had to give up a level of stability. Share prices are volatile. You can see them go up and down and then down and up again. Now, sure, you can get your money out quickly, but you also run the risk of making bigger losses. Well, what's the other big investment vehicle? I guess it's putting money into a savings account or something like that. And while that is very liquid and stable, it's just not going to give you wealth-producing rates of return. So if I had my choice, and actually I do, I'd take stability, lack of big swings in prices, over liquidity anytime. Over the last decade, we've been troubled by a number of world economic crises. We've experienced both high and low interest rates. We've had a mining boom and then a bust. We've been governed by, I know I've lost track of how many prime ministers, but during that last 10 years, the properties in my portfolio have more than doubled in value, but they've been relatively illiquid. They wouldn't have been that quick to sell. However, over the same period, the value of many shares, which were very liquid, hardly went up at all. I'm going to stick to property any day. Now, there's another concept on what the right sort of investment is, and that's when to versus how to investments. Now, I know many advisors recommend when to investments, which means you have to know when to buy and when to sell. The problem is timing is crucial to these investments. If you buy low and sell high, you do well. However, if you get your timing wrong, your money can be wiped out. Shares, commodities, futures are when-to investments. Flipping properties, renovating for profit and selling is a when-to investments. And so is chasing the next hotspot. I'd rather put my money into a how-to investment, such as an established capital city property, one that increases steadily in value and doesn't have the wide fluctuations in price, but still powerful enough to generate wealth-producing rates of returns. While timing is still important in how-to investments, it's nowhere near as important as how you buy them and how you add value to them. How-to investments are really liquid, but they produce real wealth. Most when-to investments produce only a handful of large winners, but there tends to be many, many losers. On the other hand, investing in well-located capital city residential real estate has produced many wealthy people over the last decades and only a handful of losers. So there you have it. We've moved to the next stage of the property cycle, and over this last 20 minutes or so, I've explained to you why not to change the strategy. The right strategy is still high capital growth And the right property is still an investment-grade property that I've spoken about often in this show. I didn't want to repeat what I've said so often before, but if you're new to the show and you're not sure what an investment-grade property is, go to the first couple of episodes on iTunes or Stitcher or on the Michael Yardney podcast. Episode 1 talks about what makes an investment-grade property. And the next couple of episodes talk a bit about my top-down approach and my six-stranded strategic approach to understand how to buy the right sort of property. So 2018 is going to be an interesting year, and that's why I'm inviting you to join me at my property market and economic updates around Australia in March, April, and the beginning of May. Go to propertymarketupdate.com.au where you can find all the details. But if you put in the promotion code podcast, I'd love you to join me as my guest. Look forward to catching up with you next week when once again I'm going to be in your ears.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.